Today, we're diving into something that's been a huge topic in the entertainment world, the rise of OTT platforms and the impact they're having on traditional cinemas in India, especially big players like PVR Inox. Now, before we get into it, let's quickly break down what we're talking about here. Now, PVR Inox is essentially the largest chain of multiplex theatres in India. We're talking about those big movie theatre chains where we've all been to, with screens that offer everything from regular shows to IMAX to 4D experiences and more. Now, PVR Inox were separate companies for years, but they merged and now they are this massive brand dominating the cinema market. On the flip side, we've got OTT platforms like Netflix, Amazon Prime, Disney+, Hotstar and more. Now, these are digital streaming services that allows you to watch movies, TV shows and even live events all from the comfort of your own home. And with internet access and affordable data plans becoming more widespread in India, these OTT platforms have seen massive growth, making streaming a favorite pastime for millions of Indians. Now, here's where it gets interesting. In recent years, the competition between traditional cinemas like PVR Inox and OTT platforms has really heated up. With more people turning to streaming services for their entertainment, especially during the pandemic, footfalls in cinemas have been declining. Now, why go to a theater when you can watch the latest films from your phone, laptop or TV, right? Plus, OTT platforms are also offering a ton of diverse content from regional films to international hits, which makes them even more attractive to viewers across India. So what does this mean for PVR Inox? How are they handling this massive shift? Well, that's exactly what we are going to break down today. Now let's talk about the rise of OTT in India because things have really changed in the last few years. Now we all know how big OTT platforms like Netflix, Amazon Prime, Disney+, Hotstar have become. But what's driving this massive shift, especially after the pandemic? Now, during the pandemic, when we couldn't go out to theaters anymore, OTT platforms took over. People were stuck at home and streaming services become the go-to source for entertainment. Now, what started out of necessity quickly turned into a preference. These platforms aren't just for TV shows anymore. They've also become the place where we are watching movies, sometimes just days after they've been released in theaters. Now, one of the biggest factors behind the growth here is the rapid expansion of 5G networks. With faster internet speeds, especially in emerging countries like India, it's now easier to stream high-quality content, including 4K videos, even in smaller towns. So internet speeds are better than ever, and that's opening up OTT services to a much larger audience across the country. Then there's the whole integration of AI and machine learning. Basically, these platforms now know exactly what you want to watch based on your previous choices. Now, the recommendations are super personalized, which keeps you hooked and coming back for more. Now, if you're looking at the numbers, OTT really took off during the pandemic, and now people's habits have changed and OTT platforms grab a bigger share of the pie. In fact, India has become the fastest growing OTT market in the world. According to a report by PwC India, the market grew by 20.9% in 2023, reaching 17,496 crore rupees, which is around $2.1 billion. And it's only expected to get bigger with predictions to double by 2028. Now, coming to traditional cinemas. According to Ormac's report, in 2024, there were 88.3 crore footfalls, which reflects a 6% decline from 2023. Now, these footfalls in 2024 are also lower than what we saw in the previous 2 years and are still not back to pre-pandemic levels. Now, while OTT platforms have had an impact on movie theatre attendance, there are also some other external factors that contributed to the drop in footfalls. For example, the Hollywood writer's strike and the lack of big Bollywood releases affected movie schedules. On top of that, elections and the T20 World Cup disrupted the movie calendar as well. Now, looking at Hindi cinema, things looked even worse. Footfall for Hindi films in 2024 saw a massive 16% decline, dropping to 23 crore. That's significantly lower than pre-pandemic numbers where Hindi cinema typically saw footfalls above 30 crore. So overall, while cinemas are still around, they are facing challenges, especially with OTT's growing influence and changing audience habits. Now, coming to PVR Inox. Now, PVR Inox, India's largest multiplex chain, was formed through the landmark merger of PVR Cinemas and Inox Leisure in March 2023. Now, this union created a massive cinema entity combining over 1,700 screens spread across 350 plus properties in 109 cities. Now, the company's roots go back to 1997 when PVR introduced the concept of multiplex cinemas in India, revolutionizing the country's movie-going experience. Now, the Indian multiplex industry has historically been dominated by a few key players. with PVR, Inox and Cinepolis holding the most share. Now, the merger of PVR and Inox was a strategic move to consolidate power and form a dominant force in this competitive market. Now, one of the driving factors behind the merger was also the increasing competition from OTT platforms. As we just discussed, the cinema industry had already been grappling with challenges due to the COVID-19 pandemic and the subsequent restrictions that severely impacted movie theaters. At the same time, OTT platforms gained significant ground as more people turned to streaming services for entertainment, leading to a shift in the landscape. Now, by merging, PVR and Inox aim to strengthen their position in the market and better compete with the growing OTT threat. Now, the merger was expected to be a transformative move, streamlining operations, improving efficiency and increasing earnings. Now, investors were hopeful that the merger would improve financial performance and lead to a rise in share price of the newly formed entity, which is PVR Inox. Now, despite the optimism surrounding the merger, PVR Inox has faced challenges in the post-pandemic era. Now, shares of the company have been under significant selling pressure on the stock market with a decline of more than 30% in the past 1 year. Now, in fiscal year 25, PVR struggled with financial losses in the first 2 quarters. The April to June quarter, which is the first quarter, was particularly difficult as it coincided with the general elections and the IPL cricket season, leading to a delay in major film releases by producers. However, the company showed signs of improvement in the second quarter. Now, coming to the recent quarter earnings. Looking at PVR Inox's quarter 3 fiscal year 25 results, on the surface, the company's performance seems relatively positive. Now, revenue for the quarter rose by 11% year over year. Now, advertising revenue, an important indicator of steady viewership, was also up by 36% quarter over quarter, and it was also the highest ever quarterly advertisement revenue since the pandemic, which shows another signs of recovery and strong engagement with audiences. Now, quarter 3 fiscal year 25 also saw the highest box office collections of 2024, alongside the highest average ticket price and spend per head for the quarter. Now, this was largely driven by the success of few major releases, including the blockbuster Pushpa 2, which alone contributed 36% of box office collections during that period. Now, moreover, PVR Inox's operating margin also improved slightly, rising to 31% in the quarter, up from 30.5% during quarter 3 fiscal year 24. Now, after facing losses in the previous 3 quarters, the company also reported a net profit of 36 crore rupees for the quarter ending December 2024. Now, despite these positives, there are signs of weakness in some critical metrics. Now, admissions, which represent the number of people attending theaters, dropped by 4% quarter over quarter, though there was a slight 2% increase year over year, bringing the total to 37.3 million for the quarter. Now, similarly, the occupancy rate, which measures how many seats are filled, remained flat at 25.7% compared to the previous quarter and only slightly higher than the 25.2% year over year. Now, the occupancy rate also continues to fall short of its long-term average, indicating that theaters are not filling up as much as expected and audience turnout remains lower than ideal. Now, one of the major reasons for this decline is the weaker performance of Hindi language films, which has led to lower foot traffic in PVR Inox theaters. Now, PVR Inox's business model remains highly sensitive to occupancy trends, which are largely dependent on the quality of content, something that is of course out of their control. Now, while big hits like Pushpa 2 can significantly boost revenues, the company is at the mercy of the movie industry's fluctuating releases, which can make performance unpredictable. Now, in conclusion, while PVR Inox's quarter 3 fiscal year 25 results show some positive growth and recovery, challenges remain, particularly with occupancy rates and the unpredictable nature of movie releases. Now, PVR Inox has come up with a plan to deal with the challenges it's facing right now and to grow in the long run. Now, the company is trying different things to boost revenue and bring more people into theaters. Let's discuss that. Now, one of the strategies PVR Inox is using is the re-release of older films. This is especially useful when there aren't many new movies coming out. Now, by bringing back popular films from the past, they can attract more people to the theaters. Now, the strategy has already worked well, and in quarter 2 fiscal year 25, it contributed to about 6% of total admissions, and in quarter 3 fiscal year 25, it contributed about 4.3% of admissions. Now, next, the company has signed on to add 100 new screens. Out of these, 31 screens will be managed under a management contract, while 69 screens will be developed using the asset-light model. Now, the asset-light model is a pretty smart move. What it means is that PVR Inox will partner up with developers who will cover the financial cost of building these new screens. Now, this can significantly reduce the burden on PVR Inox because they don't have to spend as much money upfront. Now, the content PVR Inox shows is also a big part of their plan. They've got a strong lineup of Hindi, regional and Hollywood films for fiscal year 26, including titles like Sikandar, Chava, Sitare, Zameen Par and some big Hollywood franchises. Now, with a solid content pipeline, PVR Inox expects to see higher footfalls, which is more people coming to the theater, and better occupancy rates, which means more seats filled. Now, additionally, recent tax cuts could also help improve their profits and encourage more people to spend money at the theatre. Now, in short, PVR Inox has a plan for the future. However, as an investor, keeping an eye on PVR Inox's strategy is crucial, especially considering the growing competition from OTT platforms. Now, here are the key factors that you need to focus on as the future of traditional cinema, like PVR Inox, gets more uncertain in the face of OTT growth. Now, PVR Inox's footfall numbers and occupancy rates have been under pressure, and these metrics have a direct impact on revenues. As an investor, it's important to monitor footfall numbers and occupancy rate and evaluate how well PVR Inox can turn this around with its content strategies and improve consumer engagement. Now, as we discussed, OTT platforms continue to grow rapidly in India. In fact, India has become the fastest growing OTT market globally, with platforms like Netflix, Amazon Prime, JioCinema expanding the reach. Now, this means cinemas will face even more competition in the future. Now, keeping an eye on how PVR Inox responds to this competition is essential. Now, PVR Inox reported an 11% revenue growth and a net profit of 36 crore rupees for Q3 fiscal year 25. This shows that there's still demand for the theatre experience, particularly with blockbuster movies like Pushpa 2 driving box office collections. Now, for investors, profitability and revenue growth are key indicators of a company's financial health. The challenge lies in sustaining these profits amidst fluctuating box office performances and increasing competition from OTTs. Now, the quality of content is a major driver for cinema footfalls, and PVR Inox's ability to secure strong, crowd-pulling content will play a significant role in determining the company's future performance. Keeping track of how well this content resonates with the audience will be key. Now, PVR Inox plans to add 100 new screens with a mix of asset-light and franchise-owned models. This approach allows for expansions and lowers upfront costs and increased risk-sharing with partners. Now, this expansion model could either lead to significant growth with low capital investment or face hurdles if market conditions remain unfavorable. Monitoring the effectiveness of the strategy and its impact on PVR Inox's financials is crucial. Now, to conclude, while the big screen isn't disappearing overnight, PVR Inox is facing significant challenges from OTT platforms and changing audience preferences. Now, the company's recovery will depend on its ability to boost occupancy rates, adapt to streaming competition, and deliver a solid content pipeline that keeps people coming to theaters. Now, PVR Inox's future growth hinges on its ability to innovate, adapt, and recover in an industry that's rapidly changing. So, what do you think of PVR Inox's future? Let us know in the comment section. Having said that, this is me, Merlin Susanna, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.